Zacks Screen of the Week, an overview of a timely stock screening strategy aimed at helping you produce more profitable investing results. Well, this week's screen is about stocks to sell short. And joining me, Kevin Matras, as always, Maestro of Stock Screens and head of the Research Wizard Division here at Zacks. So, with that in mind, having said that, as they say, are you expecting more downside to this stock market?
Well, it kind of looks as if that may be where it's heading. October was a tough month. November hasn't started off any easier, and really the entire year has been very, very difficult. Now, 2008 has had its share of upward moving stocks, but there's been a lopsided amount of stocks that have gone sharply lower. And with the market seemingly teetering on breaking down to new lows, it kind of looks as if we're going to see a little bit more of the same. And while I'm always looking for stocks to buy, and yes, there are good stocks to buy in this market, I have found myself more and more looking for stocks to sell short. And with the trend being down, the trend can indeed be your friend. So if you think a stock is overpriced, or if you think a stock is overvalued and you think it's going to go lower, you can make money as the price of that stock falls.
So are there any tricks really to finding these stocks, or does it all just lie in the parameters of these good screens that you come up with?
You know, there's no more trick to finding a good stock to sell short than there is to finding a good stock to go long on. You just want to find stocks that have, for all intents and purposes, kind of crummy fundamentals. The screen I'm running this week is essentially doing just that. I'm trying to find companies that are overvalued in regard to their industry. They're also overpriced, and they also have underperforming growth rates. So here, let me show you what the screen is looking for.
Okay, these are technical terms, by the way. Crummy fundamentals.
Check it out. The first item in this screen is I'm looking for companies that have a price of greater than or equals to $30. And you don't have to use something like this, but for me personally, I like putting a price minimum on these stocks because I just don't like shorting stocks that are too cheap in price. I want to make sure that they have a decent, price starting point, if you will.
Okay.
The next one, I'm looking for companies that have an average 20-day volume of greater than or equals to 100,000 shares. I want to make sure that there is a fair amount of trading activity on a daily basis. And if you were to, let's say, multiply the minimum price of $30 times the minimum volume requirement of 100,000 shares, you're looking at a company that's going to trade at least $3 million worth of shares on a daily basis. And I think that's plenty of volume to be able to get in and out quite easily. Then, as you get into some of the fundamentals, I then want to look at companies with a projected growth rate, F1 over F0, so the projected growth rate on an annual basis, and I want the growth rate to be less than the median for its industry. In short, I'm looking for companies in the bottom half of their industry that are underperforming their peers. Next, I want to see the valuations be higher than their peers. So I want the PE using their F1 estimate to be greater than the median for their industry. Again, I want to find valuations that are in the higher end of the industry, which usually means that there may be more room for those companies to pull back and fall down. Then I'm looking at the debt-to-equity ratio, and I want the debt-to-equity ratio to be greater than the median for its industry in this one as well. This shows how much a company's assets are being financed through debt. The bigger the number, the more debt financing it has. And as debt becomes harder to come by with tougher pricing, companies that have these higher debt burdens, if you will, these are the companies that are going to be more vulnerable, especially with the way credit has become so tight in the economy. I end the screen by looking for companies with a percent change in F1 EPS estimates over the last 12 weeks. I want these to be less than 0. So again, I'm topping this screen off by looking at companies whose earnings estimates have been lowered over the last 12 weeks. So not only do you have the projected growth rates being subpar or mediocre at best, but the analysts covering them are expecting them to get even worse. So I think all of these things combined make for a less than ideal picture if you're trying to find a stock to buy, which makes it an ideal stock if you're hoping to go short.
Okay.
Again, underperforming growth projections, high valuations, bigger debt in comparison to their peers, and again, their earnings projections are being lowered. All toxic stuff.
Got it. An example of a stock that came through the screen, if you would.
Sure. One of the companies that came through is a company called Air Products and Chemicals, ticker symbol APD, and they are in the industrial gas and equipment processing business, as well as a producer and distributor of certain chemicals. If you were to take a look at their fundamentals, their projected growth rate has been lowered to 2.46%, and this is significant because it is a marked slowdown from last year's growth rate of 6.42%. And while their projected 5-year growth rate is coming in at 9.33%, this is essentially half as much as their historical growth rate, which was pegged at 18.21%. So this is a significant change. If you look at their PE ratio, they have a PE of 10.14 versus the median for their industry of 8.37. Now that represents a 21% higher PE than the peers in their group. So this is a big premium, if you will. Also, too, they have a debt-to-equity ratio of 0.70 versus the industry median of 0.53. This is making APD more leveraged than their peers as well. And again, as we said earlier, this makes a company more vulnerable if, in fact, they have a difficulty in obtaining debt down the road. If you were to take a look at this stock, you can also see, too, that they're basing near the low end of their range. In fact, you can see there's kind of a sloppy descending triangle there. And it looks like if it breaks down just a little bit more, you could see a significant decline. If you see the trend that preceded that consolidation, some technicians, I myself included, would say that if you break down, you could see another decline approximately the same size. So the stock looks like it could break down even further.
Another technical term, crummy descending triangle. Sloppy descending
Yes.
triangle. Do you own that stock?
No.
All right. Anybody in your house own that stock? The dog?
No,
Thinking about buying
not
it?
yet. And by owning, you mean sell short. No, I have not sold this stock short.
You can read all about this week's screen that Kevin has put together for you and get even more stocks that have come through it by linking to it off of our homepage at Zacks.com. You know, the key to successful screening lies in discovering those screens which have produced profitable results in the past. Kevin tests all of the screens that he uses before he brings them to your attention, and he uses Zacks' powerful Research Wizard stock screening, backtesting, and reporting software program to achieve all of these screens. You can too. You can learn more about it at Zacks.com/Research Wizard. With Kevin Matras and the Screen of the Week, I'm Terry Ruffalo.